us know when we. Wow. Welcome, Emma. Welcome, everyone. Really want to thank you for taking the time out to join us today. And I apologize for my voice in advance. Let's see how we go over the next 20, 30 minutes. But essentially, we're running this webinar today to have a look at the road we have just traveled in corporate travel. And my insights shared with Emma, hopefully you can walk away with some great action points. But before we begin, I just wanted to take you through some general housekeeping. On the right-hand side of the screen, you have a chat function. Use the chat function to ask us any questions and we'll answer those at the end of the presentation. Hopefully we've got enough time to run through all your questions. Also, to make the experience a lot more insightful for everyone on the call, and we've got everyone, a lot of different people from across Asia Pac, we want to run some polls. And so we invite you to participate in our live polling and we'll let you know once that comes on screen. But again, on the right-hand side of the screen is where you complete the poll. Pardon me. So my name is Felicity Burke. I head up FCM Consulting for the Asia Pac region, and I'm joined today by my trusted colleague, Emma Duff. And as I mentioned before, what a wow of a first 6 months we've had of this year. We can see that every travel manager has been tested in multiple ways over the last 6 months. And as we move forward into the second half of this year, and into 2027, there's a little bit more insight that we're going to share with you about the journey ahead. But we can also see with the travel managers we're working with, there's a lot of renewed energy about the next 12 months. We want to equip you today with some practical industry news, and that's going to help you navigate the market disruptions that we have been experiencing and that may continue for the remainder of this year. Plus, we want to give you some balance and give you that balance back for traveller confidence through travel risk management strategies. And then the final piece is we want to help you sustain some high-performing category management plans that go beyond just measuring the cost of savings, okay? So with that in mind, I'm going to jump into the agenda. So Emma's going to walk us through air trends, travel risk management. I'm going to then jump into accommodation trends and managed travel index. So a bit of an action-packed 20, 30 minutes. I just want to shout out to the global team who we were with, fortunately, last week, who have helped us prepare for today. A lot of insights, lots of information to share. So let's get started. But before I do want to run our first poll. So I'm just going to trigger that with the team if we're ready to jump into our first poll. And I'm just going to check our notes. Maybe we'll skip that. So Emma, we'll come back to the poll once the team have got that prepared in the background. But I'll hand to you, Emma, to take us through what's happened in the airspace these first 6 months.
Beautiful. Thank you, Felicity, and thanks everybody for joining us today. We're going to kick off with the capacity story and forecast, as this underpins all of the current market trends that we're currently seeing. Every other region is growing except for APAC, which is currently flat. And it's not a recovery story, it's a capacity constraint story at the moment, and it's got direct implications on availability and pricing. So before the conflict fully disrupted forward schedules, 2026 was forecast to deliver additional 142 million seats, or 2.4% growth globally, with APAC tracking at positive 2.9%. At that particular point, 20,000+ flights had been cancelled and the Gulf hubs were already disrupted. So this slide here is showing you that early stage impact. What that same forecast looks like now. So as I said, 142 million seats in February, and the forecast was sitting at 89 million seats in May, which was the sharpest single month downward revision of the year. So 53 million fewer seats than the February forecast. We're heading into the Northern Hemisphere summer and a peak demand period, as you all know. So that tighter supply and peak demand period is textbook fare pressure scenario. Our Gulf carriers do remain disrupted. We had some conversations earlier this week and they've advised that commercial airspace has not fully reopened. So they're still operating at a reduced capacity, and that's expected all the way through to September at this stage, with some schedules not yet restored at all. Our European carriers are still lagging on recovery, with some services still suspended right through to the end of September. If we take a look at this slide, it gives us the demand and capacity picture through to April 2026 from our IATA data, and it's important context in understanding why fares are behaving the way that they are. So overall, demand has held up remarkably well. So international demand fell 5.3%, but capacity was also down 5.1%. So that indicates that airlines have managed that capacity reduction really tightly, keeping their load factors high. So careful balancing act, and that's really around managing their fuel costs. So the driver of that fall is really concentrated through that Middle East area. So those carriers saw demand collapse 46.6% year on year in April, and that single shock pulled total global demand down 3.4%. What is really important is looking at passenger load factors. They're sitting at an all-time high. So normal average passenger load factors sit around 70%. And if you take a look at our Asia Pacific load factors, they're a standout at 85.1, so the highest of any region globally. It's a demonstration of the airline capacity management and that increased demand through those routes following the Gulf closures. So the practical read for our buyers is that outside of the Middle East, demand has remained relatively robust, which means that the airlines still hold that pricing power. They are not discounting to fill seats, and that reduced supply plus the sustained demand will equal a continued upward pressure on fares. We take a look now at the three things driving our market, and they're all connected. I'll start with fuel because that is the root cause. IATA's original 2026 forecast was US $88 per barrel for fuel, and we're now sitting today at around US dollars 141. So it's still 60% above forecast, and that cost isn't going to disappear when the conflict eases. It's already baked into your base fares, which is why the fare shift that we're reporting shouldn't be a surprise. So economy is up almost 19% year on year to March, and business is up 6%. So a smaller percentage, but that's off a larger fare base. Capacity hasn't recovered, and airlines have signalled to us that they're going to tightly control that through at least the last quarter of this year. So don't rely on any last minute discounting to bail out any budget increases. Demand is still way too high for that to be a strategy. NDC is one place in this environment where buyers can actually push back on fare pressure. We see over 60% of global airlines are live with NDC content now. Lufthansa and Air France KLM are pricing dynamically through that channel, and Singapore Airlines and British Airways are putting exclusive fares through NDC that won't exist in the GDS. The practical question for your program now is whether or not your booking tool is showing your travellers all available content. In a market where economy fares are up nearly 19%, that gap has a real dollar value impact for your programs. We take a look at our 7-year global fare analysis across both business and economy class, and this is an important one for your travel budgets and your travel policies. You'll see here very clearly that Q1 2026 is seeing significant increase on the full year 2025 results. These levels now of average ticket prices are well above 2022, which, if you'll remember, it was the year of elevated fuel costs and that post-COVID revenge travel demand. So we are now matching that fare environment without the demand euphoria. So our forecast for the rest of 2026 and into 2027 is that average ticket prices are expected to remain elevated because fuel costs will continue to be passed down through the airlines. Supporting that was the IATA profitability outlook, which was published a few weeks back now. Global airline profits are expected to halve from $45 billion to $23 billion. And on top of that, the jet fuel costs are going to add $100 billion to the collective bill this year. So that's a 70% year-on-year increase. Some of that additional cost is going to be recovered through adjustment of prices and improving efficiencies, but it's not going to be sufficient to maintain profitability for our airlines. So the translation there is that fares will go up and they will likely stay up. I do think we'll see some tactical air specials towards the end of the year, so in that off-peak season, but that's going to be designed around key routes and key dates to drive demand where the airlines need to see that. It's not going to be ongoing and it's not going to be an across-the-board fare reduction. So our advice to you is to review your budgets and set realistic targets based on what we're seeing now in terms of averages. And the number that you approved against last year is certainly not going to be the right benchmark for your programs this year and moving forward. I take you now into our APAC markets, and you'll see a consistent story across all markets on this slide. Domestic fares in APAC were already moving upward through 2025, and then in Q1 2026, it accelerated significantly. The standout here is China, up $115 above the historical averages, and that's predominantly due to 2 waves of mandatory surcharge increases in April and May, which effectively repriced every domestic ticket overnight. And long-haul surcharges alone are adding around $23 to $25 per sector on top of your base fare. If you layer that on top of a domestic load factor of around 83%, you'll see airlines have zero incentive to discount fares or to reduce fares. All other markets in the APAC region are seeing increases. They're not isolated movements. They're all responding to that same fuel shock that we've discussed earlier. So fare moderation is not coming in the near future. IATA and S&P Global both project that fuel prices will stay above $100 per barrel through 2026 at least. So for anybody that's benchmarking against previous budget assumptions, those numbers are no longer going to be valid. So if you haven't stress tested your policy and budget against these new average ticket prices, we recommend that conversation definitely needs to happen now. I'm going to shift through now, a little bit of a change of pace. Obviously, the Middle East disruption is the underlying cause of everything that we've discussed already. FCM Consulting prepare regular advisory reporting for our FCM customers. I'm going to share a little bit of a snapshot of that with you today. So this slide represents 4 months of compounding disruption, most of it landing directly on your budgets. And the numbers on this slide really do tell you the scale. So 75,000 plus cancelled flights. Fuel is still sitting 65% above pre-conflict levels. That's not a spike. It's a new floor that carriers are now going to be pricing against. And there's a $34 to $56 billion hole in regional visitor spend to the Middle East that's suppressing the recovery investment that we need to see for airlines. For APAC buyers, the exposure hits differently depending on where you sit. So Australia and New Zealand lost direct Gulf routing almost entirely. So that left us with fewer alternatives, longer journeys and materially higher costs. The Asian markets faced a different problem. Capacity redeployed away from those Gulf connecting routes on already compressed availability in corridors that have been tightened for quite some time. So every market felt it, just through a different door. The network carriers are starting to recover, but recovery in seats doesn't mean a recovery in fares. So the demand absorbed that capacity faster than the pricing has adjusted. And as I mentioned earlier, the European carriers still remain largely absent from Gulf routing under the EASA's bulletin, which is still active. To give you a bit of an overview, obviously we've talked a lot about the costs and the fuel costs, but when that conflict began on the 28th of February, the industry response wasn't immediate. So airlines did absorb the shock for a few weeks, but then from mid-March, the dam broke. So what you're seeing here is, and we've measured this over the last few months, 86 pricing events across 47 airlines in roughly 10 to 12 weeks. So surcharges are painful, but they do sit separately on your tickets and they get reviewed. So when the fuel situation eventually normalises, there is a mechanism to bring those back down. 22 airlines didn't add a fuel surcharge, they went straight into base fare increases. So no separate line item, no reviews, and no mechanism for removal when the conditions improve. The cost is now baked into every published fare, every corporate rate, and every GDS display, and it's going to stay there until the airline chooses to refile. Historically, they don't refile down quickly, and some never do. So when I look at this slide, what I see isn't a record of what's already happened to your budget. It's a preview of what your next contract negotiation looks like, because you're now negotiating off a higher base against carriers who've now normalised that in their own base modelling. The cost story is one half of this, but the other is risk, and the two are connected because organisations that didn't have their policies and processes in place in February absorbed both the disruption and the cost. So when a crisis strikes, you find out really quickly what your program is actually built for. And what February exposed for most organisations is the difference between having a framework and having one that actually works under pressure. So insurance war exclusions were triggered overnight. For some traveller populations, so contractors, expats and residents, fell outside of your standard traveller tracking. Approval processes couldn't move at the speed the situation required, and there was a lot of misinformation being received from external unvalidated channels. Organisations that handled February well had already worked through the strategies on this slide. The ones that struggled were still building the process while the situation was live. So there is huge value in doing the work now and not reactively. And as we all know, there are going to be more events. The next event is not going to wait for you to catch up. So if we can help you with any of your travel risk management plans, please give us a shout out. I think now we are going to roll into our next poll. Thank you.
Great, thanks, Em. They were some great insights, and I love the stats as always. Just while you were presenting the poll results from the start of the webinar, was really interesting. 71% of attendees today are indicating that they can see their travel costs, their airfare costs have gone up 10 to 15%. Now, taking into consideration, we've got audiences right across the region. Some are predominantly domestic travellers, some are international. So so interesting stat there. And then on the second question around what's your primary response to rate increases, 42% of the audience, so nearly 50%, are holding the line on absorbing the cost of travel at the moment. So that'll be interesting to see if that's something that can be endured for the next 12 months. And then 28% of the audience are reducing their travel volumes. So still traveling, but at less cadence and frequency. So yeah, some interesting insights in there. And we will peel down the next poll as that runs in the background. With regards to that poll, actually, I'm just getting the results in now. Where is the loudest pressure of the travel spend coming from internally? It's looking like 40% of the noise is coming from our CEO, finance, CFO team members. So that's really interesting, and that's really resonating around the fact that cost is impacting businesses right now. And then heading into the remainder of 2026, what are the worries that the audience have the most of? It's airfare volatility. So 70% of participants. So I think, Emma, really interesting stats there. What are your thoughts around the airfare volatility? 70% of our people on the call are concerned in that space.
Look, based on the conversations that we've been having and what we're seeing in terms of forward forecasts across capacity and fares themselves, I think that we're going to see them remain high for quite some time yet. It is going to take some time for carriers to readjust their schedules and to bring more seats into market. And as they've indicated to us, they're not ready to send empty planes just yet. They're going to do their damnedest to keep planes full, which means pricing will stay high. We may see some last-minute discounting of fares where they are trying to fill those aircraft, but that's certainly not going to be the standard. So I think at least through to the end of September, October, the indication is that fares are going to remain and schedules are going to remain as is. we may see some easing towards the end of the year and early in 2027, but it isn't going to be quickly. So buyers are correct to make sure that they've got some plans in place to manage their air costs. And, their recommendations there remain the same as always. Advanced purchase flexibility during these types of situations are always two really good recommendations for your travelling community.
Perfect. Thanks, Em. Great insights. Okay, so now we're going to change up the pace a little bit. We are going to move into accommodation. So with that in mind, we're going to reflect on the first half of this year and then talk a little bit into the remainder of this year. It is RFP season. Although I say that and I look at the customers we're working with, we have not stopped our RFP. So a lot of the content we're sharing with you now is off the back of RFPs that have been closing in the last couple of weeks that the teams have been working on, and we're continuing to ramp up right through to 2028 rates as well. When we reflect on the first quarter of this year, we can see that globally, the average room rate is hitting $212 US, and that's up $13 from the same period in 2025. So it's quite a substantial jump. And every region, this is the first time we've seen every region have an average room rate increase during the quarter. Over the last couple of years, I must admit, Asia and Australia and New Zealand have been quite flat with rate movements, but as you can see, this first quarter of this year, the rates have climbed up quite considerably, and I'll go through that in a little bit more detail in a moment. When we look at occupancy, it's the same, it's the same model with regards to the supply and demand for airlines. Is we've got passenger load factors. Here we've got occupancy levels. This is all powered by STR, who we partner with and collect their data to understand what's happening in each of the capital cities around the world. There's a lot of numbers on this screen, but you can see that Middle East passage where occupancy levels have started to decline in this first quarter, a little bit out of step given normal quarters, but given what's happening in the Middle East, quite understandable. Markets such as Sydney and Hong Kong and Tokyo, where occupancy levels are still really, really high, are driving up the rates. So yeah, you'll see that in the next couple of slides. But overall, as a hotelier, a very healthy map of statistics there, apart from the Middle East. As Emma mentioned before, as the Middle East starts to open back up again, we will see hotel specials just to stimulate those early travelers coming into region as well. When we look at Asia, and I'm just going to jump back there. When we look at Asia overall, so as I mentioned, rate increases. What's going to be really interesting is as we head into the remainder of this year, we are going to see some further rate increases across the region. And then into next year, as the economic climate starts to improve and there's a little bit more confidence, we're going to see a lot more business activity within the region. But overall, markets such as India have been seeing some quite considerable rate increases. When we look a little bit closer to where Emma and I are today, Australia and New Zealand, definitely the standout markets are Perth, Brisbane and Hobart, where the occupancy levels are high, increases in rates have been considerably high as well, which is a bit of a contrast to New Zealand, where Wellington, Auckland, etc. rates have been softening just a little bit, while the outer cities such as Queenstown and Christchurch and Rotorua, the average room rates have been climbing in market there as well. So that'll continue for the remainder of this year. We'll still have those seasonal highs and lows. What's really interesting is when we look at the major hotel chains, such as your Hiltons, your Marriotts, your Accor, the RevPAR increases that they've been seeing just in the first quarter of this year are between 5 and 10%. So those major chains, not disregarding their operating costs are rising, no different to our costs of living. But those major chains are really driving up rates to cover their operating costs and also to meet demands. When we look at kind of starting to wrap up all this information, and Emma and I are really conscious we've kind of hit you with a lot of little nuggets of information and numbers and stats to take away for your travel program. The one thing that we are always talking about is it's not just about the cost. I know cost is front of mind for everyone as part of the discussion that we're having today and moving forward as we start to plan our next financial year. But we have just recently launched the FCM Consulting Travel Impact Index. Now, this is a free assessment. There's no obligation. I strongly encourage everyone to take a moment off the back of this webinar to go and complete the Travel Impact Index. It will guide you through a series of different topics that relate to your travel program, and it will help you articulate the value of your program beyond, as I said, just cost, okay? It'll give you will walk away from doing this assessment and it's going to give you a 90-day plan. I wish I could do that just for the business that I sit in. It's not that easy, but for a system to run you through a series of questions, give you a report back and also a 90-day plan, you've got a bit of a gift from us to you to get you moving into this next 12 months and hopefully a bit of a handy framework around that. Now, we have the ability to see how everyone's been going in this value index. And you can see here on screen, we've broken down some of the responses by industry. Manufacturing industry, so if you're part of that, or if you're from professional services, maybe you want to get a little bit more competitive. But essentially, these are some of the scoring stats that we wanted to share with you to give you an insight of how everyone is tracking when they're completing this index. Again, I'm not going to go through a huge amount of detail. Go and explore it yourself and grab a free 90-day plan on us, okay? So to wrap up, the call to action is, I reflect on what Emma was talking about before with the Middle East, and our travel risk management plan is we need to remember to act fast, and your plan has to be live and agile at every turn of event. When we're looking at cost, get ahead of this current financial year. If you're a fiscal year or a calendar year planner, get ahead of your costs and adjust your budgets based on the forecasts that we've shared with you today, and also manage the expectations of your CEO and finance teams internally around the costs coming ahead. We do talk about renegotiating ruthlessly, and we're seeing a lot of our customers starting to change supplier strategies, and that's in response to cost. We understand that a lot of businesses still need to travel just as much, but they've got to do it a little bit different. And so that's where we're encouraging people to work with their suppliers a little bit differently, and we are starting to see some movements there. And then finally, it's time for you as travel managers to reframe your conversation internally around your travel program. And what I mean by that is, well, actually just do the value index, get your 90-day plan, and that is going to put you on a little bit of a different journey, a little bit, some new collateral and arsenal to take away from today's session. But it is time to reframe your conversation around your travel program. Okay. So thank you. Now we are going to move to questions, and I
do have a few questions in there today, Felicity. So I can start off with one of the airline questions that we've got in here around air budgets and the concern around how quickly things are changing in the airline world. What can you do to protect your air budgets? And, we spoke earlier about making sure that you've got your policy parameters set correctly. So do a policy revision if you haven't already. definitely meet with your suppliers, renegotiate where you can, have the discussions about what they can do to support you in your program. And you may need to look outside of policy sometimes. It's not a popular opinion, but it is an extremely cost-up market at the moment, and some fares are significantly higher than what we expect to see. So there may be some routes that you need to consider alternatives. But negotiation, definitely your purchase behaviours, making sure that you're purchasing well in advance, that you have some flexibility around those tickets. And sometimes look at your cabin class. If you have restrictions around cabin class usage, there can sometimes be better deals to be had by upgrading a cabin class. Not always, and it's not the traditional trend that we would see, but certainly you need to be looking at all options in this current environment. Felicity, I'm not sure if you can see those questions, but there's a couple there around accommodation that you might like to pick up.
Yeah, I can just see one from Emily. So just wanting to understand the hotel market in Asia and how that compares to other regions. And should we be adjusting our RFP strategy accordingly? Yeah, absolutely. Pricing, the hotel pricing, evolves every couple of years. And what we're seeing is a lot more dynamic pricing coming in. That may play to your benefits, to the benefits of the travellers from a cost perspective, but you really do need to do your numbers and assess, what is the best commercial offer for you and your travellers. But also we're reminding people to have a look at your rate caps. Emma mentioned it before around policy and so forth is, don't forget to review your rate caps. And if they're going to be locked and loaded as is they are today, then you need to change your supplier strategy to fit those traditional rate caps. So hopefully that gives you a bit of insight there. But yes, Asia market is moving upwards. Shui, thanks for the insights. Hotel strategy and top hotel chains. So obviously, just having a quick read of Shui's question there is, considering the hotel strategy and negotiating preferred rates for the year ahead, either they're hotels or chains, and should we look at alternate content? Yep, I think looking at alternate hotel content is always something we're looking at. Your TMC does, and so do your travellers. What we need to be mindful of is when a hotel booking is being offered is what are the conditions that are coming with that from, outside the GDS from an OTA. So just, making sure you've got the right room types, cancellation conditions, inclusions, etc. So you just need to be really mindful of the room type that you are being booked. But typically, the more you aggregate, the more conversation you have with your suppliers, the stronger the rate savings are going to be year on year. So that is the recipe that won't change is your buying behaviour and compliance and control in that regard. Next question is from Juliet, and Emma, are you happy for you to jump in?
Sure. This one's around policy. So if you haven't reviewed your policy in the last 12 months, where should you start given everything covered today? And I love that you're asking for a friend, Juliet. Lots of friends on the webinar today. My advice really is to start with the travel management index that Felicity discussed earlier. I personally have done the index, and it's a really great way of understanding where there might be gaps in your program, which are definitely going to inform how you approach your policy. We also offer a benchmarking service, so we can have a look at your policy for you and tell you where that's performing against your peers and where there's opportunity for improvement. But certainly the Value Travel Index is a great starting point. And as Felicity pointed out, once you've completed that, it gives you your strategies for the next 90 days, which is really helpful in starting your program. But like I said, informing and developing your policy. So that would be my advice. I don't know if you've got anything further to add to that, Felicity.
No, I think the other thing is over these next couple of months, we're going to be coming out to market with a bit more insight around that value index as well. So so hopefully some sound bites may assist you, Juliet, as you're crafting out your policy review. Great. I don't know if we've got any more questions, but I'm really happy, Emma, to have spent this time with you. I know we spend a lot of time together, but great to get an air update and your latest insights of what's going on. I know you've been talking with a lot of the airlines most recently over the last week. I just want to thank everyone again for tuning in today. Your involvement in the poll and the live questions has just made it a little bit more insightful and a bit more sharing with the other attendees. I hope our updates provided you with some confidence in managing the next 6 to 12 months of your travel program. Use the index as well. A recording of this webinar will be sent out after today's session. We'll also share some links to FCM Consulting content that we've referred to today as well. As always, if you've got any questions or you'd like to just catch up with either Emma or myself, please just reach out. And thank you so much. Have a wonderful rest of the day.
Thanks, everyone.